Hi guys, so the husband asked me if we should move our ISAs. So it's that time of year again, and it comes as no surprise, it's ISA season. The last couple of months of the year where the narcissi, or daffodils to you and me, are in full bloom and the ISA ads are all around us. It's a question for every year really. Shall we move our ISAs? Past, it was probably a pretty easy response. Check the fees, and if there was a cost advantage to move, then move. However, times have changed, and particularly in the last couple of years, and as the complexity of our ISA demands have changed, and also the market for ISA providers has evolved, and it's not easy as just picking top level fees. So here it goes. Here are some prominent providers that are scenario driven rather. And one final caveat, whilst we are bombarded with ISA ads right now, you can change your provider whenever you want to. It shouldn't be a mad rush to the door each April to fix your shizzle up. And one more final thing, do your own DD, like I'm doing right now with you guys. I'm not a financial advisor, so disclaimer and all that jazz. The first fundamental consideration when buying ISAs is what you will use the ISA for. That really comes down to whether you'll buy funds in your ISA or pick stocks. My husband and I pick stocks, and for stock because there are fees. We need to think about these because they can massively rack up the cost expenditure, and those costs are trading costs, account costs, which can be complicated, and FX costs. The last one I am quite fixated about because us retail folk don't really consider the cost of buying foreign shares. Both FX rates and other fees the ISA providers can just literally tack on wherever they want. Drum roll! But you might be a frequent trader, and there are some institutional style brokers that we should also be aware of, particularly if the free options such as 212 or FreeTrade are letting us down for whatever reason that might be. Now, IG Group themselves is a cost-effective option where you are trading multiple trades a month, and in month 2 onwards, it costs £3 a month for UK stocks, and US stocks are traded for free.
Why would you dream that?
This does massively undercut the heavy hitter, the largest provider, Hargreaves Lansdown. Also, it's cheaper than the other strong providers like AJ Bell and Interactive Investor, the latter being my favourite provider for pensions. By the by, there are also other options which are not dependent on prior month trades, such as iWeb, which charges £5 per trade. That being said, the cheapest providers for regular traders are FreeTrade and 212. Disruptive startups have next to nothing, if not no, setup fees and offer free trading. Is there a catch though? Well, not really for now. People complain about the custom services. In my own experience, it is slow, and that is annoying, especially when I'm trying to make a withdrawal. Over the recent months, it also feels like the business model for free trades might not be as sustainable as we once thought, and so FreeTrade has an account fee now of £40 per annum, and Trading 212 is imposing a few stealth charges, guys, look out for those, like deposit charges and FX fees, which may really leave you feeling like, ugh. But what if you don't trade often? Well, welcome to the club, neither do I, which means many more options are available for less frequent traders, as dealing costs are less of a concern, and it's all about reducing the overall expense of your account, which in this case means that annual fees become very important, especially when you're factoring the expenses of your account. Again, there is no surprise that the free options still win, with FreeTrade and 212 offering no dealing feels. Imagine they were giving you feels. By the way, they do not charge any dealing fees or account fees. But if you are kind of uncomfortable with the model or have had a bad experience, then there are prominent names that provide plans that are catered for us holder honors, if you like. So here's a table right here which shows the various costs, and you realize that the costing models of each firm is quite cumbersome, and so the best way to manage the costings is to model them like you like. So here I've worked out, assuming an ISA of 50k and say 20 trades a year, what the cost could look like. The 50k will put you into the capped account fee for annual fees, which is similar in my scenario, and by doing the modeling we realize that there is a big gap between the disruptors and the existing providers, and actually the most expensive are the largest providers, HL, Interactive Investor and AJ. My only caveat to this is that I pick small caps.
Okay, and what do you want me to do about that?
212 and FreeTrade at the time didn't really have the full universe of stocks, and I wanted that. That's improving all the time, so worth a review of them if you don't like buying foreign companies. If you like buying foreign companies though, which makes a lot of sense because we've talked a lot about home bias on this channel, and that is where the concentration risk is tied to our home market. Say for instance, I have a UK job, I live in the UK, and I tend to invest in UK companies. So it makes a lot of sense to diversify away from your home bias. And it is more true with the UK in recent times, especially where there's Brexit and dependence on non-tech businesses in the UK, which have left the FTSE, unfortunately, trailing global markets both in the US and Europe. But how do we do that in our ISA cost effectively?
You guys are in a crisis. I'm on my way.
Well, again, it depends, and I have found that if you trade just US stocks out of the UK, there are better options. The cost actually comes in two forms: the dealing costs and the commission on FX rates. So with 212 now also introducing an FX spread, there are no free options I could find, guys. Ooh. What about regular topping up though? Final scenario is those that top up their accounts regularly, and of course providers love that, to both encourage habit building, which in turn is good business for the providers as well as a committed customer. It's these kind of subscription models which are great revenue streams for businesses, and brokerage accounts are no different, guys. As with all subscription models, it's important to ensure that you're getting value for money. The majority of those subscription services we as consumers don't extract value from, which is why they are so predictable for the banks. Anyway, AJ Bell, Fidelity and HL cut dealing charges to £1.50 if an investor sets up a monthly plan, and account fees are already topped at £45 per annum. This could actually be a huge saving, especially for those with smaller sums of money that want to trade often. That being said though, I am about investing rather than trading, and really if that's what you want to do, trade that is, by the way, then I think that the free platforms of 212 and FreeTrade really just trump these good old established providers. So the question is, what am I doing? Well, I really should be switching my ISAs over to 212 or FreeTrade, and I think this year is kind of the time maybe to pull the plug and do it, as pretty much all of my small and mid-cap picks are now available on these platforms. But guys, I have to say, making investment decisions should be a thoughtful process, and it should be simple too. One of my favorite recent videos is one that is very close to my heart, which is investing for children, and so here is the playlist. Go check it out. It covers the basics of building wealth for your children, which will come in handy for young adult life. And I'm not gonna lie, honestly, if I had this when I was a kid, I would have been loving that uni life. By the way, the earlier we start, the earlier the magic of compounding can happen and can set in. So click here and I'll see you over there.